Why small saving fails and big capital wins. Most people are told the same story about money from a young age. Save a little every month. Don't spend more than you earn. Be patient over time, the math will work. It sounds responsible, it sounds safe, and for basic stability it is. But here's the uncomfortable truth. For most people, small saving does not build real wealth. It maintains survival. It might buy peace of mind. It rarely creates freedom. Meanwhile, big capital seems to multiply almost effortlessly. Those who already have money gain access to better returns, better opportunities, better information, and better protection from risk. The gap widens not because the wealthy are smarter or work harder, but because the system itself rewards scale. This essay is not about shaming saving or glorifying greed. It's about understanding how wealth actually grows, why the usual advice fails so many people, and what separates financial stability from financial power. If you want the truth about building wealth, you have to start by unlearning a few comforting myths. The comforting lie of small saving. Saving is sold as a moral virtue. If you struggle financially, the implication is simple. You didn't save enough. You weren't disciplined enough. You wanted too much too soon. This framing is convenient because it individualizes failure. It shifts attention away from structural realities and places the burden entirely on personal behavior. Let's be clear. Saving is necessary. Emergency funds matter. Buffer matters. The problem is not saving itself. The problem is the promise attached to it. Saving small amounts from ordinary income does not compound fast enough to outrun modern economic forces. Inflation eats purchasing power. Housing costs rise faster than wages. Healthcare, education, and basic living expenses consume more each year. Meanwhile, interest rates on standard savings accounts hover just above zero in real terms. If you save $200 a month for 30 years and earn a modest return, you may end up with a respectable sum. But respectable is not the same as transformative. It will not change your position in the economic hierarchy. It will not buy leverage. It will not create optionality. Small saving preserves what you already have. It does not meaningfully change what you can do. That distinction matters more than most people realize. Stability is not wealth. A stable life and a wealthy life are often confused, especially in personal finance advice. Stability means your bills are paid, emergencies don't ruin you, and tomorrow looks similar to today. It's valuable. Many people never reach it, and that's not their fault. Wealth, on the other hand, is about control. Wealth means your time is not fully owned by an employer. It means risk is optional rather than catastrophic. It means you can wait for better opportunities instead of taking the first available one. It means you can make long-term decisions without being crushed by short-term consequences. Small saving aims at stability. Big capital creates control. The tragedy is that people are often promised control through a strategy that only delivers stability, then blamed when the results fall short. Why time alone is not enough. You've heard the phrase, time in the market beats timing the market. It's true as far as it goes. Compounding over long periods is powerful. But compounding has a scale problem. Compounding works best when three things are true. The initial amount is large. The return rate is high. The time horizon is long. Most people only have access to one of these, time. If you start with very little and earn average returns, time helps, but it does not perform miracles. Compounding a trickle still produces a stream, not a river. Meanwhile, those with large starting capital don't need extraordinary returns or extreme patience. Even modest gains on large sums produce outsized results. A 7% return on $10 million generates more in a year than many people earn in a lifetime. Time helps everyone, but it helps the already wealthy far more. The real advantage of big capital. Big capital does not just mean more money, it means access. Access to investments with higher minimums and better risk-adjusted returns. Access to professional advice that goes beyond generic rules. Access to private markets, early deals, and negotiated terms. It also means insulation. When you have significant capital, you can afford volatility. You can wait out downturns. You can buy when others are forced to sell. You can take calculated risks because failure does not threaten your survival. Small savers don't get this luxury. Every decision carries more weight. A mistake hurts more. A downturn feels personal. Risk becomes something to avoid rather than something to price. This asymmetry is not about intelligence, it's about margin. Risk is different when you're poor. Finance textbooks talk about risk as a percentage or a standard deviation. Real-life risk is more physical. If you are living paycheck to paycheck, risk is missing rent. It's losing healthcare. It's falling behind in ways that compound negatively. When you are wealthy, risk is a bad quarter. Because of this, the poor and middle class are rational to avoid many high-return opportunities. The downside is too steep. The same investment that is a calculated bet for one person is a potential disaster for another. This creates a cruel loop. Those who most need high returns are least able to pursue them. The wage ceiling problem. Most people try to build wealth by saving from wages. This is like trying to fill a pool with a teaspoon. Wages have a ceiling. Even high earners hit limits based on time, energy, and market demand. Raises are incremental, promotions are scarce, layoffs reset progress. Saving from wages means your wealth-building engine is capped by someone else's budget and priorities. Big capital is different. It earns without clocking in. It scales without additional effort. It grows while you sleep, travel, or fail. This is why wealth is not primarily about frugality. It's about ownership. Ownership is the real game. Every meaningful discussion about wealth eventually comes back to ownership. Owners get paid first and best. They benefit from growth, not just labor. They capture upside rather than trading hours for fixed compensation. This includes ownership of businesses, real estate, intellectual property, equity, and systems that produce cash flow. Saving prepares you to own. It does not substitute for ownership. The mistake many people make is stopping at preparation. Why just invest is incomplete advice. Telling people to just invest assumes they have surplus income, emotional bandwidth, and enough margin to withstand volatility. For many, they don't. Index funds are a powerful tool. They are not a cheat code. They reflect the market, which reflects existing power structures. They reward patience, but they do not break hierarchies. Investing passively with small amounts is better than doing nothing. It is not a strategy for leapfrogging economic classes. That doesn't make it wrong. It makes it limited. The myth of equal opportunity compounding. A dollar does not compound equally for everyone. For a low-income saver, a dollar is fragile. It might be needed for rent, food, or emergencies. It cannot stay invested no matter what. For a wealthy investor, a dollar is patient. It can sit, ride volatility, and wait for favorable conditions. Compounding assumes uninterrupted time. Life interrupts the poor far more often. How big capital actually grows. Big capital grows through a mix of leverage, scale, and asymmetric bets. Leverage allows control of large assets with relatively little cash. Scale reduces costs and increases negotiating power. Asymmetric bets offer limited downside with massive upside. These tools are often inaccessible or dangerous without sufficient cushion. This is why wealth tends to stay clustered. The same mechanisms that grow it also protect it. The role of networks and information. Money travels in social circles. Deals are shared quietly. Opportunities are discussed before they are public. Trust reduces friction. Big capital often sits inside dense networks of lawyers, bankers, investors, and operators who speak the same language and recognize each other. Small savers operate in isolation, consuming mass market advice designed to be safe, not transformative. Information alone is not enough. Context and access matter. Why hard work is not the deciding factor. Hard work is common. Wealth is not. Many of the hardest working people in the world remain poor. Many wealthy individuals outsource effort entirely. Effort matters for survival and progress. It is not the primary driver of large-scale wealth. Position matters more than perspiration. The psychological cost of always playing defense. Small saving puts people in a defensive mindset. Avoid mistakes. Cut costs. Delay gratification. Don't fall behind. This mindset is exhausting and limiting. It trains people to think in terms of scarcity rather than opportunity. Big capital allows offense. It enables experimentation, failure, and long-term thinking. It turns money into a tool rather than a source of stress. Why inflation is a silent tax on savers. Inflation punishes idle money. When your savings grow slower than the cost of living, you are moving backward even if your balance increases. Big capital tends to sit in assets that reprice with inflation. Small savings often sit in cash or low-yield accounts. The result is a quiet transfer of purchasing power upward. The truth about safe choices. Safety is relative. Avoiding risk feels safe in the short term. Over decades, it can be dangerous. The biggest risk for many people is not market volatility, it's stagnation. Big capital can absorb shocks. Small capital must grow or slowly erode. What this means for real people. If small saving fails to build wealth, should people stop saving? Saving is the foundation. Without it, everything else collapses. But saving should be treated as a staging ground, not the destination. The goal is to convert saved labor into owned assets as quickly and intelligently as possible, building toward capital, not just comfort. This requires a shift in thinking. Instead of asking, how can I save more? Ask, how can I own more? Instead of focusing only on expense reduction, focus on income expansion and equity creation. Instead of avoiding all risk, learn to take calculated, survivable risks. The unfair reality stated plainly. The system favors those who already have capital. Pretending otherwise helps no one. Acknowledging it does not mean giving up. It means choosing strategies that reflect reality rather than slogans. A more honest definition of success. Success is not having the biggest savings account. It's having assets that work when you don't. It's having options when others have obligations. It's having time, flexibility, and resilience. Final thoughts, truth over comfort. Small saving is not a lie, but it is incomplete. Big capital does win, not because of morality, but because of mechanics. Understanding those mechanics is the first step toward changing your own trajectory, even within an unfair system. The truth may be uncomfortable, but it's also clarifying. You don't build wealth by being perfectly behaved. You build it by owning pieces of the world that grow. Saving keeps you in the game. Ownership is how you win. If this video made you think differently about money, make sure you joined Legacy Finance. This channel is about the truth behind wealth. Not hype, not shortcuts, just real conversations about ownership, power, and long-term thinking. New videos break down how money actually works, why most people stay stuck, and what it really takes to build something that lasts. Like the video if it helped. Comment with your thoughts or questions. And subscribe so you don't miss what's coming next. This isn't about getting rich fast. It's about building something that outlives you.